Larry, let's talk about the Fed meeting, more importantly, that Fed pause. Not necessarily a surprise, but do you think it was appropriate?
I'm not sure. I found the Fed's action a little bit confusing. I understand the arguments for not hiking at this meeting, but those arguments wouldn't point towards signaling two further rate increases. They wouldn't point towards significantly revising the forecast towards a stronger economy and more inflation. I understand the arguments for having gone the other way, but I don't really understand the internal consistency of an approach of pausing at this meeting, but then signaling two further rate hikes down the road and signaling that they no longer expect unemployment to increase nearly as much as they used to expect it. So this meeting felt like it was driven as much by the internal political dynamics of the Fed as by any consistent and coherent reading of the economic situation. And that was a bit disturbing to me.
They raised some of their economic projections, or at least they improved a little bit here. But you still have a market that seems to be betting on this idea of a recession, the idea that the Fed itself may have actually over-tightened, or at least is on its way to doing that.
That would not be my best guess. I think it's very hard to read, but my best guess is that the consumer, which is 70% of the economy, appears to be running really quite strong at this point. We've got very strong employment data, much faster than population growth. The indicators on wages are a bit mixed, but the ones that seem most reliable to me that adjust for changes in the composition of the labor force are showing substantial strength. So I don't see the idea that we've got a durable reduction in inflation clearly established, nor do I see clear evidence of a slowing coming. So in that context, I think the Fed has probably got to maintain a posture of moving towards restraint. I don't think it's very serious what the precise timing is, and so if they don't move this time and they end up lifting rates 50 basis points at the next two meetings, that's going to be okay as an outcome. But I think that they ought to decide what their balancing of risks is. Mm-hmm. And I was struck that the balancing of risks that was implicit in not moving today, this time, was kind of inconsistent with the balancing of risks that was signaled by the two tightenings and by the forecast revisions.
I want to go overseas to China. They had a much different policy meeting coming out of the People's Bank of China, a cut. And there's been a lot of discussion here, Larry, about the health of the Chinese economy in light of the data we've gotten and in light of some of the reports by Bloomberg and others that they are considering fiscal or at least some sort of economic stimulus measures to get that economy going back again.
You know, I think the Chinese have a very difficult set of challenges ahead of them. There are very serious financial overhangs coming out of what's happening in real estate. I take a somewhat more medium-term view of it. And what's an economy about? An economy is about people and it's about capital. And what we know is that the number of births in China has fallen by almost 50% in the last 6 years. Even though they eliminated the one-child policy, the number of births has kept really falling. Mm-hmm. And we know that Bloomberg reported that the number of millionaires leaving China was kind of high by historical standards and high by global standards. Now, that's a funny measure in a lot of ways, but if you look at measures of attempted capital flight from China, they look to be pretty strong. And if you look at measures of capital inflow, what you saw from Sequoia, where they were splitting off their China business a week or two ago, is indicative of a lot of things that are happening. So whether it's supply of people, investment in new capital, I think you've got some fundamental bets that aren't running that positive in China.
Yeah.
And that's going to be a challenge along with the nearer term issues for the Chinese economy. And so that's something that for them I'm worried about. And I think that's something that's going to point towards there being more softness in commodity prices globally than many might have expected. And we've seen a certain amount of that in the oil market.
Let's move over to the European Union, Larry. We got the ECB rate decision, a hike as expected, and discussion from Christine Lagarde that the market should expect additional hikes here. When you look at economic conditions over there and you look at monetary policy here, are they in sync?
You know, I don't think the objective really is to have policies in sync. I think the objective is to have policies appropriate to particular circumstances and then to let exchange rates adjust. And I think the inflation issue is probably a more severe one in terms of Europe. They haven't moved nearly as far as we have in the face of somewhat greater threats. So I think the European actions were broadly appropriate, and I think they're going to very likely need to continue acting, especially given that I think that monetary policy in the United States is more likely to surprise in terms of tighter rates than it is to surprise in terms of greater ease.
Before I let you go, Larry, I was just trolling through your Twitter feed here, and I saw you tweeted out something related to a paper on the IRS. There's been a lot of discussion here about the funding for the IRS, about the funding and its capability of auditing folks, and more importantly, the return that it gets off of those audits.
Look, we don't have many better investments in government. What this study, which is the most careful one done to date by my colleagues at Harvard, Nathan Hendren and Ben Sprung-Kaiser, along with government officials, finds is that $1 invested in increased revenues, increased enforcement with respect to top 1% taxpayers, people who are audited at a rate of only a little more than 1%, people who in some cases file returns and the statute of limitations runs and the IRS doesn't even notice, that a greater investment in those that area of tax audits can pay off $12 at every in extra revenue for every dollar that is invested. And it's got to be, in that context, penny wise and ton foolish to be underfunding the IRS.